Hello and welcome, What the Finances, to another episode of the What the Finance podcast, where we talk to experts to help gain a greater understanding about what has happened to the finance, investing, and markets. On today's podcast, I'm happy to welcome back Antonio Linares for a second time. So, Antonio, thanks for joining the podcast today.
Thank you for having me again, Anthony. I'm very excited to be back.
Yeah, looking forward to speaking. I obviously didn't scare you off the first time, so see if we can do that again this time. But during our last conversation, you spoke about your investment framework, which focuses on companies that excel in electronic management. And I know you recently released, I think it was an article talking about this framework. So can you maybe give our audience a little bit of an overview of your thinking on this matter?
Yeah, so I think I've been subconsciously working on this framework for probably a decade now. And as you well said, back in October, I took a crack at kind of formalizing it a little bit. And the title of the piece that I wrote is Electrons and Dollars. And it essentially comes down to the idea of companies that currently are or have in the past laid down an infrastructure, which is all about electron management, right? So if you think about a business like music is just about consumers listening to tunes, right? And then the moment Spotify came into the market after Napster and stuff, it's all about sending electrons back and forth. It's just sending signals around the planet and then have people consume these signals in an orderly and coherent manner that somehow adds value, right? So a lot of these businesses, and including Spotify, look terrible in the present financially. But basically, given a certain organizational structure and a series of properties, these companies in the affirmative case, ideally, are basically optimization machines. So what it means is that once they have that initial infrastructure where they're just moving information back and forth, they can add subsequent additional layers of electron management to add value incrementally to the stakeholders of their platforms at a marginal cost, right? So one very simple example, as it refers to Spotify, as everyone knows, pretty much everyone knows, people listen to music on Spotify and artists post music on Spotify. But, the business is terrible because the labels keep 75% of the money that Spotify makes. Now, for example, they just released a feature which enables you to buy concert tickets, right? And so in relative terms, that feature is free for Spotify because they don't have to build the entire infrastructure again. It's just a little bit of code. And now they can start making fees at a marginal cost of near zero as you buy tickets for the to go watch the artists that you consume in the platform anyway, right? So when they add enough of those features, then basically the income statement should be meaningfully transformed. And so there's a lot of companies like this today, and actually today's most recognized companies, the ones that pretty much everyone knows are the world's top companies and so forth, have been an example of this development. Amazon, which is one that I'm doing a deep dive on this month on, is exactly that. It began selling books online, and it looked like a good business, but it was sort of hard to tell. And it's easy for me to speak about this in hindsight, right? But it was hard to tell that it was going to evolve beyond books and then into cloud computing and so forth. But essentially, they just laid down that infrastructure, which they've been iterating on for 2 decades now. But they went from books to other categories, and now fashion, apparel. Now they're doing food, but essentially the core of the business is electron management. And you can see how their financial profile has been transformed through time, and it's nuanced, right? I mean, analyzing Amazon is not simple, but essentially everyone can tell now that it's become a much better business. And that's because they've been deploying these additional layers of value at a marginal cost on top of what seemed like a relatively innocuous and sort of non-menacing initial infrastructure. So that's my thesis. And I titled it Electrons and Dollars because I realized that if you see the graph of the world GDP over the last 2 millennia, essentially it's flat from the year 0 to the year 1700 and so forth, and then it just goes up exponentially. And it's highly correlated to our ability to process information, which in turn stems from our ability to work with electrons. So that's kind of my vision for the future, Anthony.
Yeah, it's really interesting. When I listen to that, it's sort of like the electrons, data or information, and then I guess these the infrastructure is sort of like a network. So basically, these companies build this massive network, and then from there, once they have these people using their platform, they can then integrate these more systems they can make more money off, basically.
Correct. My initial the way I got to this initially is thinking about how humans, what is the core mechanism that humanity has been employing to generate wealth, right? And if you go back through that period of time from the year zero, or even before that, up until the time we are at now, it's basically about unlocking new atom configurations. So everything around you in the world stems from some human saying, hey, if we do this and that, we can put atoms together in this way and it yields this benefit and therefore it adds value. And that's how our economy is built. But then I sort of started going deeper into the structure of an atom and realized that the core of this millennia is going to be electrons.
Yeah, it's really interesting. So I guess from your perspective, are you looking at the industries that could be revolutionized by better sort of electron management? Is that your sort of focus, or are you more just looking at these companies that you think are doing it very well? What's sort of your plan in this regard?
So it's definitely a company by company basis, because what I try to do is I try to buy platforms that are very, very undervalued, right? So if you look at a case like Spotify, even when it was selling at a price to sales ratio of 4 about a year and a half ago, I think that in hindsight, that's going to come across as incredibly undervalued, because people are looking at it as a music streaming app. I'm seeing it as an audio network. And then I have a number of examples that are very similar to that I bought at reasonable valuations, but that even at much higher multiples, I think in hindsight are going to seem like they are very undervalued. And the thing is that there's two sort of overarching theses that I think are going to play out, which is one, the fact that applying AI on top of these networks is going to accelerate the pace at which they deliver incremental value, and it's actually going to bring the cost even down more, right? So it's when I talk about a marginal cost of near zero, I think that's going to be more pronounced as AI kicks in. And then the fact that we are also, in the past decade or so, we figured out a way to read, edit, and write genetic code. And so now genomics is coming into play. And I'm pretty fond of the idea. I believe that in the next decade or two, we are going to solve the problem of material scarcity by leveraging this idea of platforms and incremental value layers by just getting really good at understanding genetic information. So those are the two overarching theses. But as I say, I think that it comes down to a company by company basis for me, for sure. You can't really generalize here.
Yeah, definitely. And then I guess you could say, I remember when we were talking last time, it was market was going down, and since then the sort of market's gone down a bit further. Do you think there's a maybe method in your framework where you could analyze more about the, I guess, cyclical basis of the economy, and then from there you can understand maybe you're not definitely not going to get the absolute top or the absolute bottom, but maybe you can then get in at better multiples? Or is, from your perspective, is it more just over the long term you're going to win no matter what, as long as you choose the right companies?
Well, look, I think that the more time you spend in the market, the more you can get a feel for what stage of a cycle you are in. Having said that, you can never really truly be sure. And timing the market is always a complicated game, right? So generating wealth in the market is complicated per se. If you try to add a dimension of timing, it's even more complicated. What I think is that when new layers of value emerge in the economy, the proliferation of them seems to be pretty perpendicular to macro variables. So rates can be up or down or whatever, but if you figure out some new way of adding value to humanity in a cost-effective manner, and the operation is well managed and so forth, I think that eventually companies do get off the ground and the stock goes up and you do make money. I've been doing this like this ever since I got started in the market, right? So when I made my first two investments in 2014, which were AMD and SolarCity, which was then acquired by Tesla, my thinking was very similar to now. Of course, I didn't really formalize a framework like the one I'm talking about now, but I did realize that in 10, 20, 30 years time, we're going to need more computation, and then we're going to need energy for cheaper, right? So, and actually, I think that the AMD investment was far better recent than the SolarCity one. But essentially, I was betting on trends that I think would play out regardless of macro variables and on which way they evolved. And actually, the two investments went down a lot in the first 2 years, right? I always talk about this. So AMD went down 75% over the course of 2 years. So that was very slow and painful. And then SolarCity went down 50% overnight when it was acquired by Tesla. Right. So I just think that, and you can't really bet on trends generally and in a diffused manner. I think you have to find the vehicles that are appropriate to do so, which in hindsight, these two companies were, and I got lucky and so forth. But I think now that the vision is sort of the same. I'm just betting on things that I think are going to happen in the world and in vehicles that I think are going to make it happen.
Yep. So it's thinking about those trends, and then from there is looking at the companies that you think will do well during those trends.
Yeah, correct.
Best positioned.
Correct. Which, going back to the electrons on dollars thesis, it's not just about the idea of deploying an initial infrastructure and then adding layers on top of it, which of course, that's the core of the thesis, but there's some underlying properties that enable a company to do that. And essentially, these companies are optimization machines. And where that ability to optimize and iterate relentlessly comes from is from an organizational culture where information flows transparently, where failure is accepted and oftentimes encouraged. They tend to have flat hierarchies and decentralized operations, so that effectively a company like that becomes the best it can be at processing information, right? Because what a company essentially is an optimization function in that it has to minimize the inputs and maximize the outputs. So to do that, an organization has to be the best it can be at processing information. And these properties that I talk about is what enables that. And if you study companies like Amazon, Walmart, Costco, and one of the, some of the biggest successes of the past 10, 20, 30 years, these are the properties that all these companies share. And so when I find companies that are getting very good at electron management and have these properties, then I do tend to think that those are the appropriate vehicles to bet on regarding the trends that I'm talking about.
Yeah, no, it's really interesting. I think it's quite a unique way of looking at sort of analyzing companies. So one of the companies that you have high conviction on and you've done a deep dive on Substack is Meta. And I think it's a company that a lot of people have written off as well. So I guess, can you explain why you think the average and I guess institutional investor has it wrong and why you think they could really outperform in the coming years?
Sure. So just to be clear, I don't have a position in the company as of today, at least yet. I'm actually analyzing Amazon this month just to sort of compare the two and figure out which one I would rather invest in, following my concentration principles. So I don't want to invest in the two. I want to pick the one that I like better. The thing with Meta is there's been a number of narratives that sort of have built on top of the company's fundamentals. Fundamentally, I think that over the past year or two, everyone was thinking, TikTok will kill Meta, and it's true because Meta has sort of it's developed this how shall we say, it's in the minds of its consumers, it's developed an image of kind of perhaps not treating them that well. Kind of, it's a bit of a mousetrap, right? A bit of a limbic mousetrap. So people feel like it's an addictive product. Mark Zuckerberg is not well liked, and then all of a sudden comes TikTok, which is essentially a weapon of the Chinese Communist Party, I believe. And everyone is using it, and the algorithm is very generous, and it gets people views, and it gets people's creator careers to take off and so forth. And people are sort of contrasting that dynamic with what Meta looks like today, which looks like a stagnant company that people don't really trust, led by someone that people don't really like or understand. And so, this narrative has I think has put in a brake on the company's evolution, at least as seen by people on the outside, right? And then we have the new sort of pivot towards the metaverse, which I think is in part the result of I think Mark Zuckerberg and the management team getting slightly too excited at the beginning of the pandemic, thinking, the world is going digital now. We're never going back to, people were thinking like that. We're never going to go back to bars. People are never going to travel. So during that time, I think that the company started investing very heavily in this new idea of the metaverse, and then hiring a lot of people, which they've laid a lot of recently and so forth. So the financials have taken a toll. And then, this narrative of TikTok coupled with the financials taking a toll, I think have led people to think that the company is dead. But fundamentally, this is a network that spans roughly 50% of the world's population, right? And then the company has a track record of making transitions very effectively when the market thinks it can't. And so one example is when Meta, which was then Facebook, transitioned to mobile from desktop, and the market believed it couldn't do it, and consumers believed it couldn't do it, but then it did. And it has a number of these transitions through time, which I'm going to enumerate now. And then the other one is when Instagram, no, not Instagram, when Snapchat came along, and that was very disruptive too. And Instagram was mostly a feed, right? And they then transitioned to stories. So that was the second successful transition. And so it has a history of doing that. And now essentially it has to move towards one, AI, two, privacy. Because the idea of consumers feeling not as well treated as they could be in the context of privacy and respect for the limbic brains and so forth, I think it's true. I feel like that as a consumer. And then AI is just the next frontier, right? So then there's a further narrative, which is Meta can't monetize WhatsApp, right? But actually, the company is building a new flywheel, which kind of addresses all these concerns, which I think the market is undergoing. So going back to your question, this is what I think the market is getting wrong now. So fundamentally, the idea that Meta can't monetize WhatsApp, I think, is false. In Q1 2020, the company was just laying out the vision for what it calls click-to-messaging ads. So the idea that a consumer can be, in whatever of their many surfaces, just surfing the internet, checking out photos, videos, whatever, and then clicking on an ad. And instead of having that consumer go through the traditional funnel that we would otherwise be used to, it basically initiates a conversation between the consumer and the company. So you click on an ad, then you talk to whatever company is being advertised and so forth, and then that initiates the top of the funnel, right? Per the results of Q3 2022, the business is now at a 9 billion annualized run rate. So, essentially, Meta is now connecting their advertising infrastructure with their WhatsApp/Messenger infrastructure. That was at $0 in Q1 2020. Today, just a couple of years after, that's 9 billion. So I think that the monetization is doing well. And then a lot of that is a lot of the potential for that in the future is about Reels. So we see how Reels are getting more and more addictive. And I'm seeing people of my age. I'm almost 30 now, unfortunately, I'm getting old. But I see people age 20 and below using Meta, Instagram specifically, and sort of getting as addicted to Reels as I see people being addicted to TikTok. And then I see discovery being driven in the product as well. So I think that they're actually doing AI very well. And here are the metrics. In Q3 2020, Reels was an infant and just getting rolled out to 50 additional countries. So they were just in the rollout phase. Per the results of Q3 2022, there are now 140 billion Reel plays every day across Facebook and Instagram. And there are also 1 billion Reel shares on Instagram daily. Right. So in Q2 2022, Reels accounted for 20% of the time spent on Instagram, representing a 30% sequential increase from the previous quarter. So here we have Meta, one, fixing the narrative of they can't monetize WhatsApp. And, in combination with this problem they had with the Apple update and the idea of privacy and stuff, now it's not about immediately spying the consumer. It's about funneling the consumer into a conversation with merchants, right? It's totally different. And then we have Reels taking off, which is this new surface, which incidentally is actually yielding negative revenue as it redirects attention from other surfaces. But the two in combination are creating this very powerful flywheel, which has the potential to give the family of apps a second and actually perhaps far more explosive life, right? And so fundamentally, going back to what I was saying, you have a network that spans 50% of the population, which is fixing the two problems it has, and it's actually gearing up, I think, for another 10 years of a very successful life, right? And so further, the idea of the metaverse is that Mark Zuckerberg is funneling all of the company's resources into the metaverse initiative, and this is actually not true. If you read through the quarterly filings and you see the financials and so forth, the truth is that most of the quarterly expenditures are going into family of apps. And then the philosophy of the company regarding the capital allocation is to allocate a percentage of the profits generated from family of apps into the metaverse. So I wouldn't say that the company is dead. I would say that there's a bit of an asymmetric situation here. So long as the AI via Reels does pick up, I think what you have is a surface that's actually very valuable that people continue to use. I think it's going to be relevant for another 10 years. And then I think that the idea that the way the company is playing out the metaverse, it's per se for the company an asymmetric call option. So I think that as an investor, if you can get this at a low enough price, you're sort of buying the asymmetry of the asymmetry. So to me, this looks like a meaningful opportunity for the next decade.
Yeah, it's really interesting. I think in the podcast, the article as well, you mentioned how it took stories quite a while to actually start making money, and it's the same for Reels. It's going to take quite a while for it to start making money, but I think comparatively, it's actually making more in a shorter time than stories did when that was implemented. If that's correct.
Yeah, that's totally correct. And then from a philosophical standpoint, when 2 or 3 years ago, the market thought that Amazon and Meta were both indestructible, if you study the companies in depth and you go back in time, you realize that they went through periods of investment like the ones they are going through now when they were seriously doubted. And if you see the questions the analysts were asking on the quarterly conference calls and stuff, they were sort of framing their questions in a way kind of like, well, the company is dying now, but how do you think the investments will play out? So it was completely the opposite to what we were seeing 2 or 3 years ago, right? Now we're back to that. So you can see that the perspective of the market as it refers to the investment cycles of these companies is highly volatile, and the financial memory is very short. So, going back to Meta, I think the company has been through a number of transitions. The market was very pessimistic about this. As you said, it took them a while to make money through stories, but these investment cycles keep playing out. And right now, I think that the company is sitting at a meaningful discount. There's just one thing about the thesis that I haven't really been fully able to weed out, which is the idea of culture, right? And I was very, very impressed when studying the company at just how much people love to work there. And you wouldn't say so just by looking at Mark Zuckerberg and seeing the way he talks and stuff, right? But people love working there. It has all of the properties that make a workplace desirable, both for workers and for investors. It's just when people love working somewhere, then the company is bound to do all right, because the employees are going to be happy, they're going to innovate, they're going to work hard and so forth, right? But the problem is that as they invest into the metaverse is a fundamentally different operation than family of apps. Family of apps is about optimizing click-through rates and engagement and so forth. And then when you hear the executives at the reality labs talking about what they're doing, they sound very proud about working from at the photon level upwards. So they're going deep into physics and so forth, and it's a very, very different game. So then the question is, where do the best engineers want to work now? Do they want to work in reality labs, or do they want to continue working in family of apps? For the investment to be truly asymmetric, what you need is for some of the best talent to work in both. Because if family of apps degrades, then there is no floor to this, right? And then there is no capital to sustainably allocate to the reality labs initiative and so forth. So I think that's something that I'm looking out for, and I'm still not very clear on it.
Yeah, it's an interesting thing to think about. So you mentioned Amazon and how you're comparing it, and I know you said you have a deep dive, which is when's that releasing? Sorry, into Amazon.
By the end of this week.
By the end of the week. So unfortunately, we're not going to be able to go too deep into it, but just get a few thoughts about Amazon. So I guess the challenge with Amazon as a company, you have the sort of cloud section of it, and then you have the traditional business. And I guess they're two very different things, and they've got two very different networks. So from your analysis, I guess, how did you quantify that? And then how can you compare it to something like Meta?
I think that the main takeaway from this deep dive is, again, that financial memory is very, very short. And if you review the company 2 decades back and you read the quarterly reports from every year and you read Jeff Bezos' letters and so forth, it's just incredible how the company has been through a number of investment cycles, to call them something, right? Because they're just continuously stepping up the investment. It's not really a cycle. But during those periods, the metrics that, like operating margin, free cash flow, they tend to wither. And then the analysts on the conference calls tend to get pretty pessimistic. And the questions to management are sort of framed in a way that if you are a retail investor or just an investor in general, if the sentiment in these calls if you get impregnated with the sentiment in these calls, then you're automatically going to tend to see the company in a negative way, if that makes any sense, right? It's sort of a very interesting psychological phenomenon. It's kind of like you could be seeing a company at any point in its history in the last 20, 25 years in a positive light or in a negative light. And that very much depends on the sentiment in the market, right? But fundamentally, it's just been doing fine all along. Even after the crash in 2001, the metrics were doing well. It had a strong balance sheet. It's been focusing on advancing consumer convenience, selection, and price all of these years, and it's continuing to do so. And over the last 2-3 years, what has happened is the size of the network has doubled. The working capital has actually reversed. And Amazon has done that because one of its key philosophical principles is to buffer the consumer against price increases and to keep the convenience at a very high level. So what I think is has happened is that it's overstocked, right? And it's increased the size of the network because the e-commerce consumption has exploded during the pandemic, right? But that has essentially reversed the financials to an extent which we haven't seen in the past. But it's not a situation of a nature that is unusual in the company's history, right? If that makes any sense. So it's expanding again. It's expanding the capacity. The metrics are sort of suffering in the short term. And I think that in the long term, it's going to continue doing just fine. And now it's sitting at a 50% discount from its all-time highs, unless I'm mistaken. So to me, it's looking like a good buy at the moment.
So would you say the value comes more from that network of, I guess, a traditional delivery, or is it from the web service?
So that's the second derivative of the conversation, right? So now we've addressed the narrative that's been building up over the past 2-3 years, and the underlying fundamental property, which I think is that, the company is doing fine, it invests from time to time, and then the metrics suffer. Now, this question is different. I think that if you think about what the company is actually doing, it's building mindshare in the world's consumers, right? And I think 70 to 75%, at least of the US economy, and I believe this applies worldwide, is consumption driven. So we live in an economy driven by people buying products and services. So Amazon, in the minds of these people, which includes, I think, you and I, and pretty much every human on earth gradually, it's increasingly something that you can trust unconditionally. You can trust them with your money. You can buy products. You know that, excuse me, I have a bit of a cold. You know that your money is in good hands. If there's a problem, you're going to get a refund. The product is going to arrive fast. It's going to be quality and so forth. So this mind share, I think, is very monetizable down the line in the form of high margin digital services. So they have two avenues that I think are going to be very big in the next decade or two. One of them is already very obvious, which is AWS, and that's actually in the minds of developers, but it's still essentially the same. They are consumer centric, and they're building this mindshare presence in a subsegment of the population, which actually drives a lot of the value creation, which are developers. And the number of services that they can deploy there is endless. If you look at the number of features that they've been deploying per year since AWS got started, it's been going up exponentially. So has the adoption, so has the revenue, so have the margins, right? So that's one avenue that's going to be, I think the growth potential in AWS, I think, is limitless, because as we digitize the economy further and further, right, this thesis of electrons and dollars, I think, is going to permeate pretty much every single industry. And then every single industry, maybe 100 years from now, is going to be fundamentally about moving electrons back and forth, right? And then the second avenue is Alexa and Echo. So Echo being the device, and then Alexa, the underlying intelligence, which of course sits in AWS. I think that layers on top of the mindshare that Amazon is acquiring already with their e-commerce, right? And it sort of opens, it's kind of the gateway for an endless stream of high margin digital services, whereby, Alexa can help you do the groceries, can help you pick up your kids from school, can help you clean your house, can help you, learn new hobbies that you can do inside your house. Because essentially it's tapping into your livelihood, right? So And then just to deploy these services it's essentially the intelligence that they are building with Alexa, which I would say is pretty costly. But then the features are low marginal cost. So Alexa per se is a sort of new platform where they can deploy electrons and dollars for decades to come. And then I think that the margin profile in these two avenues is going to be meaningfully different. The e-commerce business per se can in theory be just deflationary forever, to the point where it's just break even forever, if that makes any sense. Because they can, I mean, right now they have a certain way of fulfilling packages, which is, you know, just moving stuff around with planes and ships and so forth. Say in 50 years time, Amazon comes up with a way whereby they can fulfill packages very, very cheaply. What are they going to charge you for that? Nothing. And that's essentially the way that they are headed. They are headed a very deflationary path down that way. So they could try and, if they wish to, they could raise prices and start making a killing in that sense. But I think that would mine the mind share. So I think that would deplete it, which I think is the core source of value of the company, on top of which I think that there's an opportunity to build endless high margin digital services via AWS for developers, as I was saying, and via Alexa/Echo for the consumers of the world.
Yeah, and I guess one of the things that's really been growing with Amazon is their advertising revenue. So all this data and all this information allows them to continue to grow that advertising, which is really interesting. So I guess, is there a risk as well? We've seen Chat GPT, which is sort of taking the world by storm, and how that's going to be integrated with Microsoft. Is there a risk that there could be quite high competition from that?
Yeah, well, I think that both Google and Microsoft are essentially headed in the same direction. So they are going to be, over the next decade or two, deploying a stream of high margin digital services for consumers. And they are addressing different pockets, right? As is the case with Amazon, which is developers and consumers and so forth. But the next frontier, the world's economy is heading towards is AI, as I was saying. And it's all about who can get the most data, and then the most technical talent / computing resources to process the most amount of data in the most efficient way possible to create the best AI possible. So I think that now we are sort of in the bootloading phase of very big AIs. They're going to drive a lot of value. And I think that essentially these companies have access to different data reservoirs. So yeah, Chat GPT is great, but people go to Amazon to buy stuff. And the searches that people make on the interface are high intent. And I think that that can yield a massive, highly meaningful, impactful AI on its own. Google is different. People are looking for knowledge. And then Microsoft has a lot to do with enterprise and so forth. And I just think that these are data reservoirs on top of which we're going to see, you know, very impressive AIs breed. So yeah, but I think that they have different data pools.
Yeah, it's really interesting. So I know it might be a spoiler, but are you looking to invest in Meta or Amazon, or you're not sure yet?
I'm not sure. I think that both are great companies. I am currently leaning towards Amazon because I think that it's a goodwill compounding machine. And I said this in my deep dive. I think that Meta is a bit of a yin yang scenario, whereby yes, they have hijacked your limbic brain, but they've done a lot of good for the world as well, because they've enabled a lot of creators to make a living and escape a life that would otherwise be more corporate and so forth. I think that they are adding value to humanity, but I think that people do not entirely trust the product because they do understand that this is somewhat like the 21st century cigarettes. I think we all have that sort of lingering in the back of our minds. Having said that, you know, I think that Zuckerberg is a great capital allocator. The talent is excellent. The organizational culture structure is also too excellent. And I think that the company is positioned for success, but I'm sort of more leaning towards the idea of putting my money where consumers feel optimally treated.
Yeah, as you said, 70% of the US economy is based on consumption, and they have the potential to not only make money from advertising, but actually selling the products as well, which is massive network.
Yes, I think that the key asset that drives the economy increasingly loves Amazon. So, our economy is driven by consumption, and Amazon is going to work with all of those consumers. So yeah, definitely.
if they were to split there, because there's been lots of talk about splitting their AWS and their traditional business, would that change this theory?
Well, I think splitting one of Amazon's units would make sense if it did require, if one unit did hypothetically require a fundamentally different organizational culture. But essentially, all of these units do one thing, which is obsess over customers. And it's sort of proactive. So the obsession over customers pulls the innovation forward. And it really does. It's very unique for a company to do that. I don't think it's very usual. So I think that all of these units sort of retrofeed each other. And as I was saying, I think that they are fundamentally doing the same, which is working towards occupying the most and the highest quality mind share inside the minds of the people that drive the economy. So, and I think that's something that I don't think it's immediately obvious. And so unless there's some sort of pivot required in organizational culture, I think that separating the company would sort of perhaps hinder that development.
Makes sense. So, Antonio, thank you so much for your time. We've covered quite a few topics. My last question is, what is one message you want people to take away from our conversation?
The message is to think for yourself and research deeply and back in time to transcend narratives.
Yep, get addicted to the research. You were mentioning before that you couldn't sleep because you're thinking so much about Amazon. So yes,
I kept waking up just thinking about Amazon. So, but don't do that. I don't think that's a good life. Don't get there, but a little bit of that will maybe add value to your life as it has done to mine. So yeah.
Yep, that's a great message. So Antonio, thanks again for your time. So we mentioned your Substack and you're also on Twitter. Are those the best places to find you?
Yeah, absolutely. That's where I post all of my work. On Twitter, just whatever's on my mind, and then Substack, the deep research.
Yeah, perfect. I'll put that in the description below. And yeah, I've really enjoyed them. They're very, as you said, they're deep dives into actually understanding these companies, which I feel like a lot of people just do the top layer, but it's actually looking deeper into that. But yeah, thanks again for your time.
Thank you so much, Anthony. Have a great day.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.